Hello everyone and welcome to today's video. So in last video basically we understood what are bonds and what are the advantages, what are the disadvantages, who all are the issuers of bond and why one should invest in bonds, right? Now let's understand the different types of bonds available in the market with all their specific characteristics and features. So let's start this. Starting with the fixed interest rate bonds. So fixed interest rate bonds are debt instruments which accrue consistent coupon rates throughout their tenure. These are predetermined interest rates, benefit the investors with predictable returns on investment, irrespective of the alterations in the market conditions. So whether inflation goes down or goes up, the interest rate over here will remain constant, stagnant. Creditors have the benefit of being aware of the receivable interest amount periodically within the long-term investment schedule. So you can actually be aware about what the interest amount will be when you actually get the maturity of the bonds. The next one is floating interest. So floating interest is nothing but the bonds whereby coupon rates which are subject to market fluctuations and elastic within their tenures. The return on investment through interest income is thus inconsistent as it is determined by market forces such as inflation, condition of the economy and the confidence of the investors in the equity entity's bond. The next one is perpetual bond. Perpetual bond are fixed security investment options whereby issuers do not have to return the principal amount to the purchaser. Okay, so this is for the infinite term. This investment type does not have any maturity and customer benefit from steady state interest payment till maturity. These debt instruments are also known as console bonds or PERP. Next one is objective specific bonds. So objective specific bonds are basically the bonds which are offered by corporations or governments, which include war and climate bonds. Coming to the features of objective specific bonds. So, bonds have several features that investors should take into account. The popularity of this debt instruments can be assigned to some intrinsic factors that mentioned below. Face value, that is the price of the single unit of the bond issued by the enterprise. Next is interest rate. Interest rate or coupon rate basically is what the organization or the entity is going to pay periodically to the creditors. Bond interest rate are also known as coupon rate as per the tradition claiming interest on paper bonds. Next feature is tenure. So tenure or term refers to the period after which the bond matures. These financial debt contracts between issuer and investor, the financial legal obligation of an issuer to the investor or creditor are valid only until the tenure's end. Next one is the credit quality. So the credit quality of the bond refers to the creditor's consensus on the performance of the company's asset in long term. It is determined by the degree of confidence that the investor have in the organization bond. So there are various credit rating agencies that classify the bonds based on the risk of the company defaulting on debt repayment. And the last feature is tradable bonds. So tradable bonds are nothing but the bonds that can be traded in secondary market as good as the trading of shares. The can thus shift among various investors within a given tenure, and these traders often sell their bonds to other entities when the market price exceeds the nominal value, as they have an option to secure the bonds with high yield and appropriate credit ratings. So that's why they trade it even in secondary market. So hope this video helped you understand the different types of bond, the features engrossed within the bonds. We'll be out with a new video soon. Till then, stay healthy and stay safe. Thanks.